Good morning. Welcome to Daily Mortgage Rates Live with the Mortgage Calculator. Today we're going to be going through some live mortgage rates, and then we're going to be doing a deep dive into commercial properties. We haven't done commercial loans here on this show in a while, so this will be great. I hear Jose's got all kinds of cool quotes for us to look at here today, so we'll get into that momentarily. In the meantime, while we wait to go live on all the different platforms, we put the chat up on the screen. I see comments already coming in there. Appreciate it. Go ahead and drop your comments there in the chat. You can also drop any questions you have in the chat as we go through here. Maybe have some questions about the commercial properties or commercial quotes that Jose is going to be going through today. Feel free to drop those in the comments section. And it looks like we're live on all the different platforms, so we will go ahead and get started. We'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat, drop any questions you have in the chat, and we will get into it. So welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and what we do every morning on this show at 11 a.m. Eastern is go through our daily mortgage rates, our actual live mortgage rates for different programs, and then we do a deep dive into a different loan topic. Today's topic is going to be commercial property loans. So our sales manager, Jose, with 28 years of experience, is going to take us through some commercial property quotes and talk about how those loans work. But before we do that, we'll do what we do every morning, which is pull up our live rates. So Nick, if you're ready, let's go ahead and pull up our pricing tool and see what the rates are looking like this morning.
All right, let me switch my screen and we will check it out. So as Kyle mentioned, this is our pricing tool. This will show us the rates for 21st, just after 11 a.m. Eastern, and it will show us the general rates and the APRs. If you'd like a full breakdown of all of the fees that go into APR, you can get a full loan estimate from one of our 300 plus loan officers. But in order to compare the APRs across the programs, we'll set up a basic scenario, the different programs that we offer. So we'll set a loan amount here in our demo of $400,000. We'll set the LTV to 80% loan, 20% down. And we'll ask the computer to find the lowest rates we can offer for our conforming conventional FHA programs, which is usually the second option for most borrowers. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000. And USDA, we do episodes on those every once in a while. VA is only for eligible vets and active service members. If you are, let us know. We can quote it. And USDA is only for eligible rural areas. If you are looking in those areas, just let us know. We'll start with conforming conventional. We'll do a purchase, 30-year fixed loan, standard loan, primary occupant, home, one unit, state of Florida, county of Miami-Dade. For all the demos, we use an estimated credit score here of 760 and an estimated debt-to-income ratio here of 40. So let's check out the rates this morning. Woohoo! So we love it when the rates go down, right? We had some big announcements yesterday. So before on our show, obviously the rates were higher and a little bit lower now. So 6.49 rate for 2.25 discount points of cost, plus the final APR at 6.5. Hopefully we see these continue to drop throughout today as the markets are kind of stabilizing with the news. Customer doesn't qualify for conventional for any reason. Typically, the next option we want to compare, we'll set up the same scenario, is an FHA. So FHA allows more leniency on credit issues as well as a much higher debt-to-income ratio overall. However, we'll keep everything identical so we can compare apples to apples here, FHA to conventional. So, all right, these dropped as well. So best option for FHA today, this morning, 5.62. 2.375 discount points and cost, put the final APR at 6.558. So a great option here for our customers that need to use FHA or leniency. And this APR does include the upfront and yearly mortgage insurance. So a great option. And our customers that qualify for both, especially today, a bit cheaper this morning. But I expect both FHA and conventional to continue to slowly go down throughout the day. So hopefully tomorrow we see some even better rates. And if our customer does not qualify for FHA or conventional, typically most other banks or lenders customer, but that's where we love to present our 5,000 additional options with alternative income here under expanded guidelines, also known as non-QM. So, but now we have a new option pop up where we can change the income type. So full doc is what we use for conventional and FHA. So if we don't qualify for tax returns, we typically use an alternative here. We have asset related programs, business bank statement programs, investor programs are just for investments. We'll show that in a second. Personal bank statement 12-month is the one we always use for the demo. That's the most popular program. We also have RSU, stated income, VOE, 1099, P&L, all kinds of different options here. Personal bank statement 12-month is our most popular program for our self-employed borrowers. Many times our self-employed borrowers, when they submit tax returns, have various write-offs and may not qualify at all. A little extra income. We can solve that problem. No tax returns at all, just their last 12 bank statements. And we'll determine a debt-to-income ratio of 40% in our example here. Their cash in the bank, no tax returns at all. So let's check the bank statement options this morning. And same as yesterday, hopefully probably early next week, we'll see a lot of these non-QM programs start to drop. Best option this morning, 7% rate, 2.175 discount points at cost. Put the final APR at 7.85. And we're still within about a half a point of conventional as usual. So a great option, not very much difference there for our customers that need that. Tons of different options here to use bank statements and qualify where they would otherwise not. And if we scroll down, there's hundreds of variations. Some of these at a little may allow bankruptcies, foreclosures, other credit issues. Some of these may allow different ways to calculate the income, all kinds of different options. So please get with our team to find the best ones. And now let me do the final demos for investment properties as we do every morning. So we love to work with investors. We have tons of options. So we'll set up the same demo here, 80% loan, 20% down payment. And we'll find the lowest rates we can offer for conforming conventional. And then we'll our non-QM expanded guideline options. The government programs, FHA, VA, USDA, do not work for investment. So we'll stick with these two here. And starting, everything is identical as all our other demos today. We've only changed the occupancy here. So let's check out the rates this morning. See if the portfolio option is still on top. And it is, almost getting outseated here. So as I mentioned, the rates start to go down. The true conventional options may soon pop up top, and they almost did today. So we still have the portfolio option at leading. Does not require the loan level price adjustments that Fannie and Freddie programs do. So this one has 6.875 rate for 3.375. And a final APR of 7.277. And the first true conventional option here, 6.875 rate, same rate, slightly more 5 discount points, and that pushes the APR slightly up to 7.290. So almost identical here. Pretty cool. And I expect later today the true conventional will finally come up to the top there above the portfolio. But today and every day, definitely recommend our customers check out both options always. May be the best option. That's why we love to quote our customers all the different options out there. And for our final option that I recommend investors check out would be our non-QM investment properties. So we'll set up the same demo here. And this time we'll select non-QM, aka expanded guidelines here. And the first thing we must select is our income type. So the most popular income type for investment property, our DSCR, because it doesn't require any income or employment or documentation on that from our borrower. Simply use the estimated rents from the appraisal to determine a DSCR value. Estimated rents can cover the expenses, aka the property will cash flow. That's a ratio of 1.0 or higher. We even have options for ratios under 1, but for the 1.5, so we can see all the programs here. And finally, a prepayment penalty must be selected. 3 years is standard, so that's what we always use for the demo. There are some options pay that will cost more and limit the options. And there's some that allow 5 years, which which saves some money, but does limit the options that show up. 3 years, that's what we always use for the demo here. So let's check the DSCR options today. All right, still some smoking options under rate. Looks like the conventional is slightly beating it here. 6.875 rate, 3.15 discount points at cost, 7.359. So we have a conventional program beating DSCR for the first time in quite a few weeks, but I would still say 100% of investors would take a DSCR pennies above the cost of the true conventional, right? Most investors use DSCR loans even when the cost is substantially more. So definitely recommend all our investors the DSCR options, no income, no employment. You can do 5, 10 loans at a time. Tons of flexibility here. And as we scroll down the list, hundreds of variations, some foreclosures, other credit issues. Some may allow short-term rental income or other income types, and some may allow different property types. Don't want to get too confused today, but we will talk about some of our commercial properties today that use similar programs, not identical. So let me go ahead and switch my screen, and we'll get into today's topic. It's going to be commercial properties. So our DSCR loans are a what used to be considered a commercial type, now used for our standard residential properties. Everybody loves the DSCR products. But let's take it back to the true commercial world here, Jose, and talk about some traditional commercial options. And obviously for commercial properties, we have to use those true commercial options. So can you explain a little bit of the difference between the DSCR that we always talk about and the true commercial that we're going to talk about today? And then let's check out some examples.
Absolutely. So the DSCR loans that we so much enjoy as our flagship products, that concept of debt service coverage ratio is a true commercial concept, right? All commercial loans are going to use a debt service coverage ratio component to analyze the property's cash flow because the property has to be able to support itself. There's going to be different debt service coverage ratio requirements. 1.2 seems to be a very common number, meaning that the gross monthly rental income has to exceed the total property principal, interest, taxes, and insurance by 20%. So it has to cover it plus cover 100% of it plus 20%, hence 1.2, 120%. So these loans, tend to be, you can get the depending on the loan amount, I should state, non-recourse. But there are many which the ones we're going to be presenting today will have some kind of requirement that the borrower need to cover their own personal finances, and that can be accomplished either by a full doc option or a light doc option. Full doc option where they're going to review tax returns just to see their cash flow to cover their personal finances, or it can be a bank statement option, again, just to show that they are able to cover their personal finances. It has nothing to do with the income component of the property. One very important distinction between the DSCR products that we've been discussing, including our 2 to 8 unit mixed use property DSCR product and our 5 to 8 unit residential for small multifamily residential DSCR component. Those two options do not take into consideration the property zip code as a qualifying factor, meaning for all of these commercial options I'm going to be showing you here, they will ask the property zip code, and then they will analyze the population density to see if the property location meets the minimum requirements for population density. Now, that may change from product type to product type, depending how they want to underwrite it, right? They usually want there to be a high population density figure to be an additional reassurance that there will be business for that property, whether it's a 5+ unit multifamily, whether it's a daycare, whether it's a restaurant, self-storage facility, mobile home park, which are some of the options we're going to go over today. They want to make sure that there's going to be enough people there to feed the business, right? So if there's not enough people there, they already see that as a negative factor, and they just will not even proceed. So that's usually the first thing they ask you. You got the property address, got the zip code, they run it through, and then they'll tell you sorry, or they'll say, no, we're good. Now we just need the rest of the documentation. So let me share the options I have with you today. I have some very good purchase options here. Now you're going to recognize a couple of these products as stuff that we offer ourselves through our DSCR option. Now this is one of the products that we offer. We were talking about our multifamily 5 to 8 unit DSCR. Well, you'll notice one distinction here that's different is this option goes up to 80%, 80, versus the other option that we have only goes up to 75%. However, the other option, the more residential type hybrid option that we have for 5 to 8 units, does not take into consideration zip codes, right? So it's a lot easier to fund those loans in areas of lower population density where you're, still going to be great properties. They're still going to be cash flowing. They just won't have to jump through an extra hoop of fire with the zip codes. So in this case here, what I do want to point out, on these commercial loans, they're usually going to be borrower paid. In some cases, you can do a combination of lender paid comp and borrower paid comp. If the borrower wants to pay a little bit less out of pocket, have a little bit higher interest rates, we can factor in some lender paid comp into the mix, but I have not factored any lender paid comp into the mix on these, except for the SBA options that you're going to see that are totally lender paid. So in this case, you're looking at 80% LTV and an amazing rate of 8.75% for our 80% LTV, 5+ units. So this is for a multifamily. Could be 5, could be 10, could be 15, could be 20. So 80% max LTV there. Now, our next option, very popular product, self-storage facilities, right? These are super popular out there. Here we're looking again, max 80% LTV. So this option is at 80% LTV, and we're looking at 9.75 as the rate for that option. Now the borrower can buy down the rate, but this is the par rate, 9.75% and an amazing 80% LTV. Now we have a restaurant purchase here. Now this option, it could be for a non-owner occupied or owner occupied restaurant purchase. By owner occupied, I mean the owner is actually managing it and running it, as opposed to buying the location and then renting it out to an operator, right? So this option here could be for either or. Now this option does require at least 5 years experience managing or owning a restaurant. So 80% LTV max for here, but I still feel that the best option for this restaurant purchase would be an owner-occupied SBA purchase. So for this non-SBA commercial option, we're looking at 80% max LTV, and again, an amazing rate of 9.75%. We all do recall during the pandemic, restaurant financing became difficult, and in some cases, they just were not lending in certain states because of the shutdowns. But luckily, that's over, and restaurant financing is strong. So I did mention SBA. So this is not an SBA show today, but it is a commercial loan show, and definitely got to have SBA in the mix. So to blow your minds, SBA does offer a 100% LTV option. Yes, you heard me correct. 100%. Now, this is an option for existing businesses. This is not for a startup. This is not for a business that you're buying and then you're going to be building it up, expanding it, so forth and so on. This is for somebody that already has their business. They may be renting somewhere for at least 2 years. So the business has to have been in existence for at least 2 years. And now they want to buy a space for the business. Doesn't have to be the same space that they're in. So don't misunderstand the requirement. It doesn't mean that you have to be in the space you're in for 2 years and only buy that space. It just means you have to be in a space for 2 years where you have 2 years track record of paying and of earnings and of existence, and 100% financing is possible in this scenario. Now, the only catch, as you all probably know, for SBA loans is that they are owner occupied, but that means that the owner has to occupy at least 50.01% of the space. So if it's 50% or less, no go, because then it's 50-50, but it's 50.01. The owner is now occupying a majority of the space, and an SBA loan would be possible. SBA loans are a variable rate product. So you got to note that variable rate, never a fixed rate. SBA loans are indexed to the prime rate, which is currently at 8.5%, plus a margin. That's the add on to the index to get what we call the fully indexed rate. Those of you may remember that from your ARM training. So the margin could be anywhere from 2 to 3%, depending on the risk assessment by underwriting, right? So you could be anywhere from 10.5 to 11.5% for your SBA 100% LTV financing purchase loan for your whatever it may be that you're looking to get. Now, our SBA purchase 90% option is the more traditional option. Allows for 90% financing for scenarios where the business is either new or does not currently rent a space for an existing business. This is a full doc program again. All SBA purchases are full doc for owner-occupied businesses. Again, where the owner occupies at least 50.01% of the space. Here, you're looking at 10.5%. I'm not sure if I showed you the last rate. I'm so sorry. 9.875. Excuse me. No, 10.75. But again, we were talking about it was a prime rate plus a margin. I just put that rate on there, but it could be anywhere from 10.5 to 11.5. And the same for our 90% rate could be anywhere from 10.5 to 11.5. Now, here's a very popular segment also, mobile home park purchases. I'm sorry about the typo, purchase there. In this case here, 80% LTV maximum. And again, this is a program that will use DSCR option for the property cash flow analysis, and either full doc or light doc option for the personal finances of the borrower. So in this case, we're looking at a par rate for our best case scenario, high FICO score borrower of 9.875. This is, again, very important, a fully amortizing 30-year loan, 9.875, 80% LTV. Now we have our daycare facility purchase, another popular option. Again, we're using DSCR for the property cash flow analysis and full doc with tax returns or light doc with bank statements for the borrower personal finances. And we're looking at 9.875% rate, again, at an 80% LTV. And our last option here automotive repair facility purchase, right? Light industrial here. And now this same option here would be possible for an automobile dealer purchase. You know, they want to purchase a location uh, for their dealership where there may be some, light mechanical work when they're prepping the vehicles, getting them ready for sale. So here, 80% LTV max. Now you do have to remember on any of these purchases, you are going to have environmental studies, right? You'll have a minimum a phase one environmental study, and depending what the outcome of that study is, you may need a phase two, which is going to go a little deeper into any issues which may have been uncovered in the phase one. They're looking mainly for contamination of the land. So that's a big issue there. So in this case, again, 80% LTV max, which is an amazing LTV, and 9.875 rate, which is very amazing for our automotive repair facility. And you could also use this quote for an automobile dealership purchase. So a lot of great commercial options here at the mortgage calculator. I think I covered most of the most requested items, including our mobile home purchase, including our mobile home park purchase, should I say, and self storage, which is another popular item.
All right. I think one thing that's important to keep in mind, which you touched on, is remember most of these are so based on the zip code, right? The population, not only population density, but the crime rate, right? Jose, what's the other things that they're going to look
Yeah,
at?
they're gonna look at all the demographics in that zip code, and if they don't like it, they just are. It's at their liberty not to lend there. It's not like residential lending, which is subject to all sorts of protections against redlining, for example. Which could be that, right? If you're asking, like, I don't like the stats in that zip code MSA, I'm not going to lend there. That's almost a form of redlining. But on a commercial loan, that's not going to be an issue.
All right. Looks like we got a couple questions here. Let's start with the first question is what is the loan amount on the 5+ unit for the program you quote? Oh, loan minimum, excuse me.
Loan minimum. I believe that I mean, I doubt you're gonna find anything that low, but I believe that conduit is as low as $200,000 on their loans, and up to 2 million on the one that I was reviewing there.
5+ unit for less than 200,000. I wonder where that would
Right,
be.
that's what I'm saying. We do get every now and then, though, believe it, somewhere in the middle of the country where nobody's living, 5 unit for like $140,000.
But at that point, I'm sure they probably wouldn't be lending on it due to the population density and stuff, anyways. I think it all kind of works itself out almost, right? But
Yep.
next question here: can we do self storage with any of these products? Yeah, I guess that was before he pulled up the self storage actual quote, right? I'm
Yep.
assuming.
That's
Yeah.
80% LTV there on our self storage.
Which is surprisingly actually pretty popular among our investors, right? Jose, you were saying it's popular. I mean, investors love the idea of buying self
Yep.
storage.
High, low maintenance, low maintenance property, tenants that don't really bother you. If they don't pay, you keep their stuff. So and then also mobile home parks, because people are looking for options to live, lower cost options. So they're just like manufactured homes are gaining popularity now amongst our buyers for their place to live, real property that they're going to buy. Mobile home is a manufactured home that hasn't transitioned to be its own uh, real property. It's sitting in a mobile home park on land that's owned by one person, not the owner of the mobile home. And mobile home parks are going to be owned the units are owned by the person. It's not like you're buying the land and renting out the spaces. Usually they own everything, all the units in there.
All right. Well, one last thing to touch on real quick, since we were talking about, the fact that commercial can essentially discriminate against the area. When we're talking about 5+ units, can you touch on why our amazing, for example, residential 5 to 8 unit programs, how they don't check the population? So it's a great tool, right, to get out there for a lot of people don't even know they can finance 5+ units without being a true commercial loan, right? Which is how we can make sure that even if something is in a location that the commercial lenders don't like, they're not discriminated against on these other special programs we have, right?
Yeah, we have many situations where, we're financing properties in smaller municipalities throughout the United States for our 5+ unit and our 2 to 8 unit mixed use, or should I say our 5 to 8 unit residential and our 2 to 8 unit mixed use, where it would not pass the population density test at all, right? Won't pass it, but it will be able to fund unless it's designated as rural on the appraisal. That's going to be the only setback. If it comes back as a rural property, the deal is dead. There's no way around it. But other than that, you don't have to worry about demographics in an area. You don't have to worry about crime. You don't have to worry about population density. You just got to worry about it's not rural, and then the other regular factors of the loan. It is a total DSCR loan without any verification of the borrower's personal finances. That's another biggie right there. The other commercial loans, even though they are DSCR in nature in the cash flow analysis of the property, they want to make sure the property is can cover its debt service, usually by 120%. But on top of that, they also analyze the borrower's personal finances and make sure that the borrower can cover those either via tax returns or bank statements. So again, you do see, in some options here it could be, really low, right, or higher LTV, but there's a catch. You have to. There's more vetting of the borrower and more vetting of the property, which lowers their risk, which then allows them to offer a little bit lower rate.
All right. Ted is asking another question here. How about RV parks?
Yeah, they wouldn't fall under these types of loans because an RV park is going to be mainly land and the facility, right? Maybe you'll have a little infrastructure, but you're not going to have any structures, right? It doesn't usually include the RVs that park in the RV parks. So there are options for RV parks, just not none that would fall under these options that we covered at these high loan to values and at these low interests, because there's less risk for the lender here because of the type of, when you're looking at a mobile home park, those are people living there usually full time, just like a multifamily, people living there full time. There's rental income versus an RV park is more transient in nature, higher risk. So, you're going to have, definitely different terms for that.
The RV park is like a business, right? Who knows if they're going to
Yeah.
make income if they're not running a good business? So that's not really based on real estate, right? It's like, are they good at business enough to rent out the RV,
Yeah.
keep
So,
their occupancy up and all that? So,
yeah.
all right, let's go ahead and wrap it up then. I appreciate everybody tuning in. Remember, we do this 11 a.m. Eastern every weekday where we go through the live mortgage rates and then do a deep dive into a different topic like we did today. We appreciate everybody tuning in. Thank you, Jose. Great presentation today. We'll see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thank you, everybody.
Thanks, everybody.